Welcome to the Wired for Success podcast, your show for ambitious, mission-driven entrepreneurs who want to build million-dollar businesses without sacrificing their health, relationships, or happiness, who understand that in order to build their empire, they need a solid foundation, and that the more they are thriving, the more their business is thriving too. This show brings you the very best from science, self-development, and entrepreneurship to set you up for sustainable success. Hi, I'm Claudia Garbutt, the scientist turned mindset and high-performance coach for entrepreneurs, and I help you get wired for success.
Hey everyone, and welcome back to a brand new episode of the Wired for Success podcast, where we talk about all things science, self-development, and entrepreneurship that help you get to that next level of success in your life and business. Now, before we dive into today's episode, I want to share something that has been an absolute game changer for me lately. As you might know, all your behavior is driven by two main components, your physiology and your psychology. So if your body is run down because you eat crappy food, you don't exercise, and you don't sleep, well, you can't really expect to deliver your best work. So that's the physiology part. Think of it as the engine that enables your work. If you don't take good care of that engine, it will break down eventually. On the other hand, even if you eat a healthy diet and you exercise 5 times a week, but you're constantly feeling anxious, overwhelmed, and you just can't break free from your negative thought spirals, again, you won't be able to deliver your best work. That's the psychology part of the equation. So whenever you're trying to create a profound shift in your state or a lasting change in your behavior, you will want to look at those two main components and figure out how to nudge them in the right direction. Both parts are essential and they are linked by intricate feedback loops, so you want to make sure you pay attention to both parts. But sometimes, one of them is just so much easier to nudge in the direction that you want it to go, and it therefore makes sense to start there. So let me illustrate what I mean by giving you an example. You know those days when you just can't seem to get into the groove. You're trying to focus, you're trying to be productive, but something is just not clicking. Yeah, I've been there too. A couple of months ago, I noticed that my energy levels were kind of low and I had a hard time concentrating during the day. And I wasn't quite sure what was going on. I hadn't really made any big changes to my routines. And I thought, well, it might just be a winter thing induced by, not enough sunlight or something. And funnily enough, that was about the time when the guys from Magic Mind reached out to me because they were interested in a collaboration. Now, if you run a top podcast, you get lots of emails from people who want something from you. So in the beginning, I was a little standoffish. I mean, who are those guys? To be honest, I hadn't heard of Magic Mind before. So I did a little digging and discovered that Magic Mind is the world's first productivity drink. And it has acquired quite a big following and lots of amazing testimonials from happy customers. Well, next, I had a look at the ingredients. And it sounded really good. A great mix of ingredients that support your energy metabolism and ingredients that help your body reduce stress. What can I say? It looked legit. And I mean, Joe Rogan had it on his podcast and the Kardashians are drinking it. You can't ask for more in terms of credibility, right? So the fact that they were interested in a collaboration was kind of flattering, but still, I hadn't tried their product for myself and I wasn't going to promote something that I hadn't tried myself. Since they got me curious, I agreed to test the product to see what I think about it. Now, you can either drink it alongside your morning coffee or you replace your morning coffee with it. I decided to drink it alongside my morning cup of joe. Now, call me a skeptic, but despite the hype, I didn't really expect to notice much. What I noticed pretty quickly, though, was the promised increase in energy level, which was awesome, especially since it wasn't like the coffee high that often makes me jittery and nervous because I'm quite sensitive to caffeine. It was more of a longer lasting energy boost without the caffeine crash. And after drinking it every morning for 4 days, I noticed an additional benefit. I felt alert, but very calm at the same time. Now that's awesome, right? I had an important interview that day and a lot of stressful things going on in my personal life, things that had me worried that I would not be able to focus and concentrate during the interview. But to my surprise, I was able to stay calm and focused, and the interview went really, really well. Phew. It's like my mind is clearer, sharper, and I'm ready to tackle whatever the day throws at me. So that's awesome. And honestly, being alert and calm is the best state you can be in if you would like to increase your productivity. That's the sweet spot of nervous system activation that you want to aim for. Because this is where the magic happens, when you have enough energy and you can focus it. Because that's very important too, right? If you have a ton of energy, but you can't focus that energy, then you're just bouncing all over the place like a toddler on a sugar high. Now, what's the magic inside this little magic shot, you might ask? Well, let me break it down for you. So, Magic Mind is packed with all natural ingredients sourced from the best suppliers out there. We're talking about matcha for extended release caffeine, Bacopa monnieri for improved attention span and memory, ashwagandha for reduced stress and anxiety, and so much more. It's like a powerhouse of goodness in every sip. So that clearly was a case where it was easier to shift my state in the desired direction by going down the physiology route. And all it took was the addition of a delicious shot to my morning routine. Don't you just love those easy fixes? I wouldn't be sharing this with you if I didn't truly believe in this product. Magic Mind has been a game changer for me, and I know it can do the same for you. Whether you're a busy parent, an entrepreneur, or just someone looking to boost their productivity, Magic Mind has got you covered. I'm super proud that they decided to partner with me and sponsor this episode. If you want to experience the magic for yourself, you can get it at magicmind.com/wiredfs. That's magicmind.com/WIREDFS. And if you use the code WIREDFS20, again, that's WIREDFS20, you can get up to 56% off your first subscription or 20% off a one-time purchase. Trust me, it's worth it. And by the way, if you want to make the most out of this discount code, get the 30-pack because it's the best value. They're also one of the few companies with a 100% money-back guarantee, no questions asked. There's really no risk. So if you don't like it, they will just refund in 3 to 4 hours. Now, without further ado, let's dive into today's episode. My guest today is the retirement income coach, Steve Selengut. Steve has accumulated over 40 years of experience as a private investment manager with a strong focus on increasing the spendable income generated by client portfolios. Today, his role has transitioned into that of an income coach, where he's dedicated to teaching investors how to more than double the income produced by their portfolios. He's the creator and instructor of the unique working capital model portfolio operating system and the market cycle investment management methodology, both of which he developed back in the 1970s. Additionally, he has introduced several proprietary concepts, and he has also developed the investment grade value stock identification system. Throughout his career, he has authored 3 books and written numerous investment articles, with the latest work being Retirement Money Secrets, a financial insider's guide to income independence. Now, I have to say that finance and investing are certainly not my strong suits yet. So I'm looking forward to learning a lot today. And Steve will have to explain everything like he would to a 5-year-old. So welcome, Steve. And thank you so much for taking the time to be on this show today.
Well, thank you for that introduction. You really dug deep to find some of that information. That was appreciated.
Sure thing. Now, Steve, I'd love to know what got you initially in the world of finance and investments.
Well, it really goes way back, if you want, particularly the focus on income. From the time I was a teenager, and we all had summer jobs, and I kind of started a lawn mowing business in the development where I was, and as it happens, it was my father who developed the development. So, so I had a pretty good in. He would actually say, "Hey, in the summer, my kid will mow your lawn for you. He doesn't charge too much, stuff like that." But what I learned from him, though, and the way we lived at that time, was that income was really the key to his success as a entrepreneur, businessman in building homes and, that type of thing, retail, real estate development. What he did was he owned the property. He sold the land, built the houses, took back the mortgages, provided the insurance for the people, multiple lines, and wound up having 3 streams of income. He had the mortgage interest, he had rental property, so he had the rental income, he had the commissions from the insurance business. So he had three streams of income generating capital for him to buy more real estate, to take on more projects, build more homes, eventually to renovate the old homes and so on. And he taught me that if I were to put away 20%, 25% of what I made mowing lawns and just let him take care of it for me, I would see that by the time I got out of college that I have some nuts and bolts in an investment program. So that's what I did. I really didn't have much choice. He took the money and ran, So, and of course it was he that was providing the college education. So by the time I got to age 25, he said, "I got a surprise for you here for your birthday," something like that, the way I remember it. And he handed me an envelope full of stock certificates. Wow. Of what his attorney had invested for me, and they were turning it over to me to manage at that point. So I put it in with a brokerage firm with a woman. I still remember her name. Rita Akers was her name. And it's easy to remember because we have an Akers real estate company down here where I live near Charleston, South Carolina. But I turned it over to her and I started tracking and looking and doing everything I could not to lose any money. It was a substantial sum of money for 1970. And I owned nothing but securities that paid dividends. They were all New York Stock Exchange. They were all highly regarded companies. Nearly every one of them was a familiar name at the time, So that's how I got my start. And I studied and I looked at the way these things moved up and down. And at the same time, I was working for an insurance company in New York. So after I'd gotten this money, and I'd just gotten married. And so I got this big bonus, so to speak, and I just started a new job in the pension investment department there. And my job was flying all over the country with the professional account manager. I mean, wow, this is a guy who's managing billions of dollars for this outfit. And talking to their clients, I was talking about a record-keeping system, but in my mind, I was talking to this guy about my portfolio and comparing it to the portfolio he was managing, which I was actually part of in a defined contribution plan. Back then, we didn't have 401ks. We didn't even have IRAs back in the 70s, mid-70s. So your employer could have a profit-sharing plan, a pension plan, or a defined contribution plan, or some combination of the two, or all of them for that matter. So I looked at our plan and I saw a thing in my first book, the brainwashing book. I mentioned I had a story called Boeing. And we were on this plane and I was asking him about why he had so much Boeing stock in the portfolio that they were managing. And this was my defined contribution plan had this overabundance of Boeing stock. To my mind, it was bad diversification from what I understood. So he said, "Steve, you got to understand something about investing at this level. Boeing is one of our biggest insurance clients, and they like us to have a lot of their stock in our defined contribution plans." Mm-hmm. So this huge light bulb went off. I almost thought I was going to get thrown off the plane because I had made this big explosion of light in the. And I said to myself, when I get back, I'm going to call Rita up and we're going to take every profit we have in this portfolio We're going to diversify even further, and we're going to find more of these high-level dividend-paying companies to invest in. And every time they go up 10%, we're going to sell them, and we're going to do it over and over again, because it's not just based on economics. There's as much politics in there as there is economics. We're going to take advantage of this situation. That's how I got my start. And I really, really did. We really did well with it, she and I. And she would track things and make sure I knew when there was a 10% profit, we'd sell it. She'd already have researched and picked out 2 or 3 things for me to choose from to replace them with. And we keep track of the ones we sold profitably so we could do it again. We set rules. You mentioned the investment grade value stock index that I had developed, and which is no longer in use for one reason. Standard & Poor's stopped publishing the guide that used to include those ratings in it. So we had to do them ourselves. And am I talking too much?
No, that's totally fine. Such an interesting story, and thank you so much for sharing.
So that's how it all got started. Eventually, in 78, 77, I just pretty much determined that this particular job wasn't going to get me where I wanted to be. I was already making multiples of my salary in my investment program. Nice. I was getting passed over when I didn't think I should have been. I've never been one that would say that had any ego problems. I've always had maybe too much instead of too little. But I knew when I was a better person for a job than somebody else that they were advancing. So I just got tired of it. My wife pretty much told me that if I didn't learn how to, I get in a nice words, butter up my boss. She didn't use that expression. That if I didn't learn how to do that better, that I wasn't going to get very far in that company. So I really didn't know how to do that. I have always spoken my mind, and I mean, I even told my boss when he used a word wrong in a paragraph he was sending out to somebody, and he didn't like that at all. But I didn't really care, I guess. So I finally quit, and I was in touch with my dentist and this restaurateur out on Long Island, a guy who's still running Domenico's restaurant out there in I forget the name, Dix Hills, maybe somewhere in that neighborhood. And they said, sure, we'll give you. We've seen what you've shown us. We've talked to you about what you've done with your portfolio. Do that for us. And that's how it got started. 2 clients. Mm-hmm. And when I sold my business last May, those 2 clients were still on the books of the business.
Wow. That's awesome.
So that also in the financial services industry doesn't last because there's so many, popular trends and changes in direction. ETFs came on the scene. They didn't exist until the 90s. We had 3 major meltdowns. We had the crash of '87, which you didn't remember at all. We had the dot-com bubble, which you might probably have heard of. We had the Great Recession, which was, the names for things started to get more and more exciting as the more and more of the journalists got into. And when I started, there were no talk radio shows about finance or business or stocks and stuff like that. Nothing like that. The news tonight, the Dow went up 3.6 points. It's now at 1,250. Can you imagine that number when it's 38,000 today? But anyway, that's what the news was at that time. It was nothing. So I started this business with my own portfolio, building a house, 2 kids to take care of and so forth. And it worked. So.
That's amazing. Now, what do you love most about the finance industry, and what do you enjoy least?
What I like most about it is, I guess, really split between two things. Personally, I still get a thrill every time I take a profit.
Yeah.
And particularly when I take a profit on a tax exempt security like a municipal bond, closed end fund. If I take a profit on that where I've been earning, 4 or 5% tax free, and then I take a 3 or 4% profit on top of that, that's,
Sweet.
that's like a 7-layer coconut cake. It's just the best type of dessert you can have. But the other thing, and I mean this, is to know that every one of my clients is still generating more than enough money to take care of their expenses in retirement without what the old economics teacher used to say, without invading principle.
Mm-hmm.
That's the highlight of my career, that I was able to transfer what I'd done for myself into so many other people's lives.
That's wonderful. But what about the downside? Like, what do you enjoy least?
Oh, the downside is regulation.
Oh, yeah.
For sure. I mean, I've been in situations where they look at numbers. They look at the numbers of transactions in a portfolio instead of what the transactions accomplish.
Mm-hmm.
So if you've taken 100 transactions for somebody with even a 6-figure portfolio, they say, "Oh no, you're trading too much. We don't approve of day trading. You're just doing too much of this." But if every one of those transactions or half of those transactions, the sell transactions were all profits, and the rest were buying new securities, what's wrong with them having those transactions? Well, there were literally times in as recently as January, February, and March of 2020, just before the COVID,
Mm-hmm.
that 2-month COVID crash we had in the market. It was a huge crash. It was as severe almost as 87 was, but it was gone in 2 months. It just came and went. But going up to that time, the securities had risen in our portfolios to that there were many that were over 7% profits. And I now use closed-end funds. I don't use individual stocks anymore. And if you want, we can talk about why. But in these things, that's a huge profit in a fund. So, so I was taking, and they were being told by the compliance department that I was selling too much. There were too many sales going on. We can't do this. So they actually forced me to only take profits for more than 7%. My normal cutoff is 5%.
Mm-hmm.
And and I couldn't even take all of them, So all of a sudden in March, those profits were gone.
Mm-hmm.
And we had to scramble just to get any profit at all, just so that we didn't, leave too much silver on the table. And I wanted to send a note, hey, to my broker, go get in touch with your compliance contact and tell them that they owe my clients $750,000. And I want it in their accounts now. But that didn't happen, of course, because they know what's right. So those are the types of things. Those are the things that drive me crazy, and probably drive most professional investors crazy, is when you have those kind of rules and not even rules and regulations, because that's not the SEC that's doing that. That's this compliance officer somewhere who's never managed another dollar of somebody else's money in his life, saying when the SEC comes in order and audits us, they may find this inappropriate. So we don't allow you to sell that many times and things like that. So that's the type of thing.
Yeah,
Instead of looking at the end of story result of what you're doing, they're looking at a number that doesn't really make any sense.
Yeah, I see how that could be annoying. Now, in general, beliefs and emotions are really what drive our behavior, right? So, what are the most important mindset shifts that people need to make in order to become a successful investor? And what are maybe some limiting beliefs that you have noticed in people who are notoriously bad with money?
Well, I guess, and particularly with young people, one of the things is how they approach investing and what they think investing is. And based on what they hear in talk radio and news, and everybody wants to think that if it's gone up, that's always good, and if it's gone down, that's always bad. You know, and there are good and bad impacts of both. It depends on how you react to them and how emotional you get about them. But you can take it, but the whole market itself and interest rates, which are one of the features that move the stock market and move the bond market, particularly the interest rate sensitive market, is interest rates. And those two factors, interest rates and the stock market, are cyclical, just like sector economics are cyclical. The healthcare industry may be down now. The oil industry is always, up or down depending on what projections and theories are. And, every industry will have its own cycle within the market cycle. Every bond, preferred stock, mortgage, real estate investment will have a cycle depending on which way interest rates are expected to go. So there's really, it's not necessarily good or bad. It should be able to be, it's anticipated. And I've always felt that, when I see the stock market go way, way up, that it would be very foolish to throw large sums of money at it, even though everybody gets excited and does exactly that. If you have money to invest, you can still buy stocks, certainly, but you buy a smaller position because eventually it's going to go back down. And that's the only thing you know. You know that, yes, it will go up. Yes, it will go down. You don't know when. You have no clue. And nobody knows when. But people are willing to believe radio personalities who are not investment managers, who may have their own investment portfolios, of course, but they're radio personalities. They're talk show hosts and stuff like that. And they just go for it when it's up, and when it's bad, they'll be encouraged by those people to sell. Now, why would you go sell IBM just because it went down in price? I mean, how long has that company been fine and well managed and so on? And don't think of that as a recommendation. Don't go out and buy IBM. I don't buy individual stocks. That was not a recommendation. It was just an illustration. But it just doesn't make sense the way people react. Every day in the the groups I have at on Facebook where we discuss these things, every now and then I see the word no, or I know that, or it looks as though this is going to happen, or these prediction type verbiage that people put on what they say, and I shake my head. You don't know anything, and you can't afford to fall in love when you're talking about investing. So that's the key. You got to understand that this is a volatile market cycle and interest rate cycle event, and that you have to approach it as such. You don't want to just throw money at things because somebody gets excited and talks them up, or because even with new issues, even as great as Amazon and Google and any number of others did go from zero to huge numbers, 10 times as many failed. And you don't know until after it goes up. And you can still ride it up, but ride it up with a profit-taking objective and then go back in it again and again and again. But diversify every time you take that profit out. Put it into a municipal bond, put it into a preferred stock, put it into something else. Diversify. I see portfolios, Claudia. I've seen portfolios recently in my coaching business where it'll be $1 million, $2 million portfolio, and it only has 3 securities in it. That's where all this hair went. Pull my hair out. How can you do this to yourself? What if? What if the board of directors goes down in a private jet? What's going to happen to that stock? Will it ever recover again?
Yeah.
People do strange things with their money.
Okay. So we should keep in mind that everything is cyclical in the world of finance.
Right.
We should not overreact, and we should diversify.
Okay, so diversifying is what I call one of the pillars of risk minimization. You have to understand when you make when you deposit something in a bank, and banks will refer to their savings accounts as investments, but they don't include one of the things that investments do include. A bank account is guaranteed by the government and by the bank. If the bank goes under, the government will give you your money. If a stock goes under, nobody gives you any money.
Yep.
Yeah. So a bank deposit is not an investment. It's a savings vehicle. Anything that's on the New York Stock Exchange or NASDAQ or wherever, any investment involves kind of risk. And the risk and there's only one risk that's important, and that's financial risk, which is the risk of that company going bankrupt and you being a shareholder, you get nothing. If you're a bondholder or a preferred stock owner, you may get something back, but the shareholders will get zero. When Merrill Lynch, you know the name Merrill Lynch, it still exists, right? But in the Great Recession, it went under and it was picked up by Bank of America. I didn't get any money from Bank of America for the shares that I used to own at Merrill Lynch. Okay. So, that's the thing. That's the risk involved. So anytime you know that you're going into an environment where you have a risk of total loss, diversification clearly minimizes that risk. But what else? There are four I call 4 pillars of risk minimization. And the first one, of course, is quality. And this is where most new investors fail in their investment. And they do it early. I remember, a woman came to me once. She had just won the lottery in New York. And these were the days when it wasn't $100 million. It was maybe $1.3 million or $1.4 million. And she had she had won it like 2 years ago. And she had about $1.4 million left, but the number was almost twice that she won. She had started an IRA, and in those days I think we were allowed maybe $2,000 a year to put in, or started off at $1,500. So maybe it was $2,000 or $2,200. And she had done that religiously. And her IRA had about $150 in it. And her investment account was what I said, about 1.3. But she said, I can't say no to my relatives when they ask me for a loan or for this or for that. And I told her I can. And my broker, each time I put my IRA in, he had an idea for a stock to buy, and I bought it, and every one of them went under. So I have nothing left. So we'll fix that too. But this is people when they're new, they just, without checking the quality of things for themselves, they have to have rules. Like I had rules that the investment grade value stock index was made up of stocks that met these rules. They had to be traded on the New York Stock Exchange. They had to be profitable companies. That means you never buy a new issue because there's no profits, had to be profitable. New York Stock Exchange, B plus rate or better rated by Standard & Poor's. And if you had to be B plus, you had to pay a dividend. You had to meet all the other type of fundamental quality requirements. Nobody talks about fundamentals now. Most people are interested in technical indicators. And technical the only thing you can do with technical is very clearly identify what's happened in the past. And they're very valuable for that. But even the best tech anywhere cannot predict the future. Planes fly into office buildings.
Yep. Happens.
Pandemics happen. Big countries invade small countries. I mean, look, just the things that have happened in the past 5 years or 10 years.
Crazy.
These things were catastrophic for the world markets. And people, of course, since they only think up is only good and bad is terrible, they always lost money out of those things. I, on the other hand, for my clients, always take advantage of things like that. I know that feels, I don't feel guilty about it, but it sounds bad when I said I took advantage of that problem. But as an investor, that's what you do. So quality of what you have, is it going to survive these situations? Okay. It pays a dividend. So, all these things. Then the third pillar is it must pay you for the use of your money. So, for example, I never would buy a zero coupon bond, which were very popular maybe 25 years ago. Okay. Because, you got an appreciation because it was going to mature at full value. You had to pay taxes on appreciation, even though you didn't receive any money. At the end, you'd get the total amount. So they never paid you anything in between that you could spend. And I don't know if you've ever taken any economics courses, but there's a thing called the time value of money.
Nope.
Which means that $1 today in your hand is worth more than $1 a year from now, or
sure.
10 years from now. That's why when you are a homeowner and you have an opportunity to lower your interest rate on a 30-year mortgage, it's so important because you're getting $1 today and you don't have to give that $1 back for 30 years. So even if you won the lottery, it would not be a good investment for you to repay your mortgage, in my opinion. If your mortgage is now at less than 3%, which you were able to do just 2 years ago, and somebody gave you enough to pay off your mortgage, I wouldn't do it. I would invest it because you can get 10% on your money now. So I'd invest that then, and I'll just keep paying that bank back a little bit every month, Yeah. So we just covered an awful lot of information. Okay, so there's one more.
One more. Go.
One more. So we did quality, we did diversification, we did income. And the next risk minimizer is profit taking. Why is it profit taking? Because if you have all your money, and today's investment advisory firms and brokers and so on will always have you reinvesting your income from these securities right back into the securities. They call it dripping. You have a tendency to grow that, to poorly diversify. But you also, if you keep buying it at higher and higher prices, you don't get that profit that you would have gotten if you did it the opposite way and got all that money in cash and found something else to invest it in, or only invested it in things that you paid too much for before, and you can bring the cost down on those. But anyway, if you take your profits, you don't lose them like I did in 2020 when we had COVID. When my compliance department said, you're selling too much, you can't sell it unless it's above this amount. And, their brilliance cost my clients, $750,000. So you take those profits, you reinvest it, and you're selling out of love. You're not selling out of hate. I love this particular stock or closed-end fund or ETF or mutual fund, whatever its name is. I love it because I was able to take a profit on it. And I'm going to write that symbol down on my sheet of paper. And if I ever have free cash that I want to reinvest, I'm going to reinvest in that one again because I'll probably be able to do the same thing again. I may be able to. So those are the 4 pillars of. risk
Yeah.
minimization.
Great tips. Thank you so much for sharing. Now, something that I'm curious about is once people have the right mindset to start investing, what would be an easy and effective, let's just call it financial health habit for them to develop?
If you can afford to, put a little bit away every paycheck.
How much?
I can't say. Every person's different. So if you do a quick budget analysis and you see that, let's say you make, I'm gonna throw out crazy figures. Let's say you make $5,000 a month,
Mm-hmm.
okay, and your expenses are $3,500 a month,
Mm-hmm.
and you want to put 500 away for emergencies, okay. So then say theoretically you have 1,000 left for investing. So you go someplace and you start investing. Now, what types of securities should you start with? And most people will go to a firm and they'll put you in a model portfolio, or they'll put you in a fund or a couple funds and so on. I would suggest that you, first of all, that book you mentioned before, my new book, Retirement Money Secrets, it introduces a type of security called closed-end funds. And I'm not going to go into total detail, but basically it's the same principle of the ETF and the mutual fund. It owns a lot of different securities, so you have instant diversification. If you research enough and you know which companies produce the best kind, like there's Vanguard, there's PIMCO, there's BlackRock, there's maybe 50 or different well-known, well-respected firms you can choose from. And they all contain funds made up of hundreds of securities. The purpose of those funds, however, is to grow the market value, which sounds very good to you right now, doesn't it? It sounds good to you. But they don't generally produce a whole lot of income. The closed-end fund has the same securities in it as the ETF and as the mutual fund. Diversified portfolios of stocks, diversified portfolios of real estate companies or healthcare companies, all different varieties, just like ETFs. But the difference is that their purpose in life is to produce income for their shareholders. Okay. In fact, they have to pay out 95% of their income to their shareholders. So the chances of multiplying your money without as much risk, because they're all holding the same securities, these just happen to pay out a lot more income. So you have the same thing, but it usually pays out maybe 2 or 3 times as much as your average fund or ETF would pay.
Ooh,
so in simplest terms.
That.
And they're available all over the United States. There are restrictions on their use in the European Union.
Okay.
And the restrictions are, and this is going to knock your socks off. This is like one of those regulatory things, because there isn't adequate descriptive information in every language. The ordinary guy can't invest in these things, even though there are significantly more people in Europe that can speak English than there are people in the United States that can speak any of the European nations' languages, So it's craziness, but that's what has happened recently.
Wow.
So, but in the United States, they're available everywhere. You will literally find financial professionals that have never heard of them. And that blows my mind. I can't believe it, but I guess I can understand it, because I really didn't know a whole lot about them until maybe 25 years ago. and they've been around longer than mutual funds have. Mutual funds came about in the late 1800s. Closed-end funds were introduced into America about 30 years earlier than that. And I have European friends who insist that they were actually invented there in the Netherlands. and it was years before it came to America. And ETFs just started out. They started out in the 90s, the 1990s. So these things are old. They've been around a long time. They work. I've been using them exclusively for 20 years now.
Thanks for sharing. That sounds super interesting.
And they come to like if you buy Amazon, you're going to have to pay hundreds of dollars per share, but you can get this fund that's paying you right now 8-9% income on a portfolio that probably includes Amazon and Microsoft and all the oil companies and so on. That's yielding that much more at maybe $10 a share or $15 a share. I own 200 of these things, 240 of these things, and I think there are only 5 or 6 that are above $30 a share.
Wow.
And that's their goal. I mean, they're not there to grow their market value. They're there to produce income. Totally different mindset. So consequently, if you invest in this kind of thing, you have to stop focusing on market value and start focusing on income. And when push comes to shove, eventually every portfolio needs to produce income, because at one point in your life, you're going to say, I'm throwing it in. I don't want to work anymore. I'm going to live off the income of this $1,000 that I put away every month for the last 30 years.
Yeah, definitely.
So that's the ticket. That's the whole story.
Now, one more thing before we go. If we shift from financial health to holistic health for a moment, what daily habits have you developed that help you stay happy, healthy, and productive?
I work out every day.
Good. What are you doing? What does it look like?
It looks like stretching exercises, push-ups, and various types of other dumbbell exercises in the morning for about half an hour. Mm-hmm. I ride a bike any day I can, and my wife and I walk around our development every day that we can. I swim in the pool when it's open. Almost anything you can do. And we don't spend a lot of time in front of TV. And we do a lot of, at our age, we've got to make sure the marbles are still rubbing together properly. So we do a lot of numbers games and word games like Wordle and Quirtle. and there's a bunch of other ones that she does. And she does the times puzzle. And I do easier crossword puzzles than she do. But we do a lot of stuff like that. So, and we eat right. And we don't drink much. So all of those things. And I think, particularly when I was younger, I didn't really pay much attention to stuff like that because I was pretty athletic and active in sports and tennis and stuff like that. So the weight still hasn't really built up much. But if you stay active and you do these other thinking type exercises, and if you're in the stock market, if you're in the market like what I'm just talking about, and you do the research properly to determine if this is a quality investment or not, just because somebody talked about it on TV doesn't mean it's right for you. That's going to be enough to keep you.
Yeah, absolutely.
Keep your mind going.
Absolutely. You have to stay active. That's so important. So important. Yeah. So last but not least, where can our listeners find you online if they would like to learn more about you or work with you? Okay.
Well, the book, of course, is at any place you buy books, Retirement Money Secrets. I have a coaching website called theincomecoach.net. Mm-hmm. So they can also get to me there, and they can Google Steve Selengut podcasts or articles, so I'm not hard to find.
Great. Steve, again, thank you so much for sharing your tips and insights with us today. I've learned a lot, and I think our listeners have too. So thanks again for the great work that you do.
Okay, you're quite welcome. I enjoyed it very much.
Take care and talk soon.
Bye.
Thank you so much for listening to the Wired for Success podcast. I hope you've enjoyed today's episode. If you did, please subscribe, rate, and leave a review. That's a fantastic, easy, and zero-cost way to help the show grow. Just use the link in the show notes and make my day.
Want more? For quick, actionable tips and insights to guided meditations and a side of biohacking, join my inner circle and get access to exclusive subscriber-only content. Again, just use the link in the show notes to join the tribe. Thank you for your support and see you on the other side. Take care and talk soon. Bye.